The markets are shaky and headlines are full of fear and noise, but there are 3 stocks that I'm always excited about and buying this month as long as they hit the price I need them to hit. These aren't hype plays. They're smart, steady, and built to compound real wealth. Let me show you exactly what I'm buying, why I'm buying it, and what it's going to take for me to pull the trigger on each one of these this month. Stock number 1, Adobe. Guys, I hear a lot of chatter about Adobe. This is a company that for a while was the hype, was great. This company, look at this stuff here, guys. This company has 89% gross margin. That means that for every extra unit they sell, almost 90 cents of it, 90% of it, goes to the bottom line before taxes and overhead. That's an incredible number. This isn't some flash in the pan tech company. This is the king of the subscription model. Creative Cloud, Adobe, all of these things, you name it, these guys own the digital content space. But lately the stock's been tossed in the tech dumpster fire thanks to all this AI fear-mongering. Oh no, AI is going to replace Adobe. Maybe. But that's like saying calculators replace accountants, in my opinion. The reality is Adobe has almost no debt, insane returns on capital, and the kind of pricing power that makes value investors perk up. Now, most people think value investors are just these kind of people that are trying to get rock bottom prices, single digit PEs. Not the case. Adobe is one of those rare companies that you must pay more for, in my opinion. I'm doing that. Why? Because they can reinvest at high double-digit rates for years. Look at this. These are their return on invested capital. 5 years is 22%. 1 year is 29%. This means that whenever they invest money in the business, they get very high returns on it. This also shows that they're basically a moat, that this allows them to sit there and they have pricing power here. That's how you build long-term wealth. Ignore the noise, trust the numbers, and let the compounding machine do its work. Because look at this. Profit margin, pretty consistent, 30%. And AI has skyrocketed the last couple of years, and they still continue to sell well. $165 billion market cap, 175 to 180 in terms of enterprise value. That difference of 10 to 15 billion is essentially their debt. And look at this. They did $9.2 billion last year in free cash flow, and they did 7.13 in the last 5 years on average. Compare that to their net income. They have higher free cash flow than net income. That is so rare. But let's go look at the 8 pillars to see what the story is telling us. Guys, one of my favorite things in the world is right here. 6 checks, 2 X's, and the 2 X's are their valuation metrics. Now, whenever we see this, we want to remember that we're waiting for the right price. But again, this could be checks. Imagine if this company, if we knew for a fact that Adobe is going to grow 30% a year for 20 years, would you pay 23 times free cash flow for that today? Of course you would. That thing will be 1 times free cash flow in a matter of how many years. It's not just about what the metric is at. That's what confuses people about value investing. They always think it's buy cheap. Well, yeah, but cheap is relative. If a company is growing at 3% a year versus another company at 30% a year, and everything else is the same, in the same industry, same sector, but one has 30% growth, which one is cheaper based on the same valuation? The one that's 30% growth is going to be cheaper. I love companies like this. It allows them to compound. And this is my investing has changed over the last 5 or 6 years for that exact reason. So let's see what analysts think about this. Well, analysts, again, they have their bias in there, so I get that. But they have $20 in profit this year per share, going to $32 in the next 4 years. And that's, look at this growth rate, 11.5, 13%, 11.5, 10%, 10.5%. Big time growth rates. Okay, what about revenue? 9.5, 10, 9.25, 10, 7.5. Still growing steadily. Now, does that mean they're right on this one? No, they could be wrong. But guys, if you could find 30 companies that were like this, and you could sit there and invest in them at good valuations, wouldn't you do it? That's what we're doing here. Now, we have a story. We have the numbers. We put them together in our stock analyzer tool. This is why the stock analyzer tool has been used over 1 million times last year by our users, by the people in our community. The reason being is it allows us to marry these 2 things together. You got to remember that a great story at the wrong price can become a bad investment. That is the 5th tenet. I'm now moving to the 5th one because how important it is of our principle-driven investing. You've got to pay the right price. I put 4, 6, and 8% revenue growth for the next 10 years. Guys, you saw what analysts were saying. They were much higher than this. But let's be conservative. I'm fine with that. Profit margin, I did 26, 29, and 32. And free cash flow, remember, is a lot higher. Look at these 38, 40, and 42%. They have growing free cash flow and they have growing profit margin. That's what happens when you have such a high gross margin. That gross margin, 90%, means as they grow and grow and grow, their bottom line profit margin should also grow. But I'm being conservative, 38, 40, and 42. Now, what earnings and free cash flow multiple are you going to assign to this? I put 18, 21, and 24. Guys, if somebody said to me 20, 23, and 26, I'd agree with them. If somebody said to me 15, I'd punch them in the face. This is not a 15 PE business, not a 15 times multiple on cash flow. This is a company that gets high rates and increasing on its money, and it's the leader in its industry. I think it'll benefit from AI. I don't think it's going to be hurt by AI. I think it's going to be benefiting from AI. And of course, I do my 9% return. What this is basically is all I'm doing here is sitting there saying, listen, what's it worth? What's the intrinsic value? Now remember, you have to have margin of safety because we're humans, we make mistakes, and the future is unknown. But to get your kind of market value, I always put 9 or 10% in. For me personally, I put much higher returns in for my margin of safety. Now guys, before I hit the analyze button, we're doing research reports on some companies. We have a research report on Adobe. If you'd like to get that 2 or 3 page free PDF research report on Adobe, click the link below. We will email you that report as soon as you fill it out. It's a great way to just get our ideas. It's not to say this is gold. It's to sit there and say, hey, if you like Adobe or you're interested in it, here are more thorough ideas than what we can do in a 3-minute video, okay? So click that below, sign up for it, and you'll get that free PDF immediately. I hit the analyze button, boom. I have a low price of 240 to 350, high price of 490 to 650, middle price of 350 to 477. This lower price is based on the free cash flow. This current price return is based on the cash flow. So what it's saying here is if you pay today's price of 376 and my middle assumptions occur, you're going to make about 12% return on your money on a discounted cash flow model. Is that enough for you? That's what you got to ask yourself. Now, guys, the second one, this next pick will sound boring, but it's one of my portfolio's best and most powerful tools. You get dividends, you get strong companies, it's simple, it's low cost, and it just works. And guess what? It's an ETF. An ETF that I always tell people, hey, it's great, but make sure you understand what you're getting here. It is SCHD. This ETF is the poster child for everything we preach here. Value, consistency, and cash flow. Is it sexy? No. Is it going to be super growth? No. You won't get super growth from dividend payers. You're not going to impress your neighbor who's bragging about some AI penny stock. But if you're like me, which I think you are, you're not chasing hype. If you're watching this channel, you have discipline. You are chasing discipline. And SCHD gives you exposure to high quality dividend-paying companies, strong moats, high returns on capitals, strong balance sheets that won't collapse if the wind blows too hard. Plus, it's got a much higher dividend yield than SPY, less volatility than SPY, and solid options liquidity for those of you out there who are selling covered calls and selling cash secured puts to buy it. Add in that rock bottom expense ratio, and that's just a cherry on top. SCHD is not a growth machine. Even though it has companies with very high returns on capital, they tend to be more mature companies. More mature companies don't have the place to go reinvest to really skyrocket their returns. But it's reliable, like a Toyota Land Cruiser. It's not flashy, but it gets you where you want to go, and you know it'll always be there for you. And that's what we're here for. Steady, rational investing that builds wealth over time and helps you hit the goals that you need to hit. That's what's most important. Now, guys, here are the top holdings of SCHD. ConocoPhillips, Chevron, Verizon, Coca-Cola, Bristol-Myers, Altria. Tell me what here is sexy. And here's the best part. 4.5% of the, look at this, 4.35. They're all very consistent parts of SCHD's portfolio. Now, look at this. We got a dividend yield currently of 3.75%, expense ratio of only 0.06%. This is incredible. Doesn't mean I don't buy my individual stocks. As you guys know, I own like 26 or 28 individual stocks, but it allows me to consistently dollar cost average into something. Now, why am I buying it? Well, guys, as you know, I like buying individual stocks, but I'm going to be pickier about my investing in stocks than the average person. Why? Because I have 1,000 apartments. I've got 8 or 9 businesses upstairs. I can be more picky. I don't need to always be investing to hit some financial goal. But SCHD allows me to be able to dip in and dollar cost average into better quality companies. As you guys know, what leads the market up is going to lead the market down. But I don't think SCHD will do as poorly as the rest of the market that is led by Mag 7. Now, again, if you're looking for insane growth in a company, it's not going to happen with SCHD. But if you're looking for some dividend money to come in your 401k or Roth IRA where you can grow it tax-free, or your IRA, do it. This is a great way to have exposure. If you look at the history versus the S&P, apart from the last 2 or 3 years because of Mag 7, you've basically been in line with them. So unless you're buying it in a tax-deferred account, you might want to be careful about that dividend yield because that'll be taxed at a higher rate than allowing it to compound. Now, stock number 3. You probably wear this brand, but most investors don't realize how strong the business really is. It is down significantly, but the long-term setup, in my opinion, looks very solid. Let me show you why. Guys, the company is Nike. Guys, you got to look at this. Nike's all-time high is 179.8 back on November 5th, 2021. I believe, even though this athlete does not sign with Nike, Nike is like the Tom Brady in a slump. You don't bet against greatness because of a few bad games. Yeah, retail's shaky. Yes, China is a mess. And the stock's taking a massive hit. 179.10 down to $63 a share. But remember, go look at our past videos. When it was close to this number, we said, hey, we're interested sub 100. And people said, come on, Nike will never be below 100. I love when I hear that because that means it's just a matter of time. This isn't some trendy startup, guys. It's Nike. The brand is the moat, global dominance, athlete loyalty, and a cash machine behind that swoosh. And even with conservative assumptions, it clears our return hurdle. This is where discipline plays off. Ignore the headlines. Because remember, news follows the stock price. Here, Paul, Nike is the most amazing company in the world, never go below 100. Here, Nike is dead. And guess what, guys? That's what I'm hearing out there. Nike is dead. Let me ask you a question. What kind of world do we live in where 20 years from now, Nike does not exist? And I'm not sitting there saying it's not possible. But when you're here, we're trying to make bets on 30 companies like Nike. How many are going to be gone in 20 years? Guys, this is a great company on sale. That is our playbook. And Nike has the chance to be a first ballot Hall of Famer based on this. Let's go look at some more metrics here. $95 billion market cap. Guys, this was $250 billion a while ago, if not more. Net income, $5 billion essentially. Free cash flow, $5.5 billion. Now, they pay a dividend, 2.35%. Back when it was 180, this would have been around 0.8%. This is higher than the market. Not as high as SCHD. This is higher than the market overall. And look at this. Look at the debt level. $95 billion to $110 to $115 enterprise value, $20 billion in debt. Guys, look at this. Let's go look at the 8 pillars here. This is an 8-pillar thriller. Now remember, you don't just click the check here because it's all 8 checks, so you go and buy it. No, it's about understanding the story there. That's what's key here. And I think the story for a brand like this, to be able to get all 8 check marks with this negativity, makes sense to me. When will that happen? I have no idea. Nike will likely go down further from here. If we're in a start of a bear market, Nike's going to go down further. Do you have the ability to ignore the noise and still add shares? I don't know. That's what's key here. But if you're watching this channel, you're definitely on the right step there because we have no problem with that. Let's go see what analysts think about Nike stock. Well, earnings of $211 this year, jumping to $4 in the next 4 years. Boy, dead company. According to analysts, they have their bias. And look at revenue growth. Negative this year, but back to growth and not much growth. But guys, one of the big things for Nike is they're doing more direct to consumer. That's much higher margin. That could really drive their margin game. And if they're smart at Nike, they'll be buying back shares as it gets cheaper and cheaper. So let's go to our stock analyzer tool, pull up our good friend Nike, and see what we think from the past that I did. Okay. I did 3%, 5%, and 7% revenue growth for the next 10 years. Guys, do whatever you want in here. That's what's great about having a stock analyzer tool. And that's why so many people share it, because they want input in our community. Profit margin, I did 10, 11, and 12. So I didn't even give them a big bump I gave them a little bit of a bump, but not a huge bump for that direct-to-consumer model. PE, 20, 23, and 26. Growing returns on capital, and clearly a moat. Clearly, you cannot argue with me that it's a moat. I guess you can, but I just wouldn't take you seriously. And my 9% returns. Boom. I have a low price of 60, high price of 118, middle price of 84. And based on today's price, You're getting about a 12.8% return if my middle assumptions occur, including dividends. Guys, I picked 7 stocks that I think will beat the market. They're my own personal Magnificent 7. So if you're serious about finding value in this market, you have to watch this video. I just picked those 7 stocks. And no, they're not the hype stocks everyone else is chasing. These are companies with real fundamentals, strong balance sheets, and the kind of long-term upside that gets value investors excited. So go check it out and learn why they have massive upside and avoid the overpriced junk out there. Click on the next video linked on the screen. Thank you very much for your time.